Welcome back to The Long Game. I'm Nathan Carter. This voice is AI, but our focus is real, grounded, and built for investors who play the long game. Today we explore a difficult but critical question. How do you know if the financial statements are lying? You found a great company, good product, loyal customers, a charismatic CEO, but something doesn't sit right. Maybe the numbers look too perfect, or they've never had a bad quarter, or there's a strange footnote buried on page 97 of the annual report. This isn't about being paranoid, it's about being prepared. Because if you're a value investor, you rely on the numbers. The numbers tell the story. But what if the story's been edited? Let's walk through 5 signs that the numbers might not be telling the whole truth, and how you can protect yourself. Sign 1. Exploding revenue, flat cash. You see revenue rising year after year, 30%, 40%, 50%. But the cash flow? It's flat, or even negative. This is a red flag, because in real businesses, revenue eventually turns into cash. If it doesn't, you need to ask, where's the money? Sometimes companies record sales that haven't actually been paid yet, or may never be paid. This inflates revenue, but doesn't bring in cash. Look closely at accounts receivable. If it's rising faster than revenue, the company might be aggressively booking sales that haven't been collected. That's called revenue recognition risk. Think of it this way. If I sell you a car today, but you don't pay for a year, is it really a sale? On paper, yes. In your bank account, no. As investors, we care about real cash, not paper profits. Sign 2. Constant capital raises. Some companies seem to always be raising money. New shares, new debt, again and again. But if the business is profitable, why do they keep diluting shareholders? It could be a growth strategy, investing in expansion, but it could also be a cover. If a company is burning more cash than it brings in, it needs outside fuel to survive. Eventually, that can become unsustainable. Check the share count. Is it rising every year? That's your ownership being diluted. Look at the cash flow from operations. Is it consistently negative? That's a business that eats money, and you, the investor, are the one feeding it. Sign 3. Sudden accounting changes. You're reading the annual report and you notice, this year the company changed its revenue recognition method, or we reclassified expenses under a new category. This isn't always bad. Sometimes accounting rules evolve. But it should make you pause. Because accounting is like storytelling, and when the narrator keeps changing the format, it's hard to follow the plot. Look at the footnotes. Did margins suddenly improve after the change? Did reported earnings jump? Be skeptical. Ask, did the business actually perform better, or did the numbers just get rearranged? Sign 4. Complex structures and hidden entities. Some companies have simple structures, parent company, subsidiaries, clear lines. Others look like a spider web. Multiple holding companies, offshore subsidiaries, variable interest entities. This complexity isn't automatically suspicious, but it often hides risk. One example, Enron. They created dozens of off-balance sheet entities to hide debt and inflate profits. It looked brilliant until it collapsed. If the financial structure is too complex to explain in plain English, step back. You're not just investing in the business, you're investing in your ability to understand it. If you don't understand it, you don't own it. Sign 5. Management that talks too much and says too little. Words matter. Read the shareholder letter. Listen to the earnings calls. Does the CEO talk about vision, disruption, transformation, but never mention actual numbers? Or do they dismiss hard questions with vague answers? This is a red flag. Great CEOs are clear, direct, and transparent. They tell you when things go wrong. They explain what they're doing to fix it. They don't hide behind jargon. Warren Buffett once said, "Managers who always promise to make the numbers will at some point be tempted to make up the numbers." Trust is everything. So, what can you do as a value investor? You don't have to be a forensic accountant, but you do need to ask smart questions. Here's a checklist. Compare net income versus cash flow. Are they moving together? If not, why? Check receivables and inventory growth. Are they rising faster than sales? That could signal trouble. Look at share count and debt. Is the company constantly raising capital just to stay afloat? Read the footnotes. Accounting changes, lawsuit reserves, off-balance sheet obligations. They're all there if you look. Listen, not just read. Earnings calls reveal tone, confidence, evasion. Pay attention to what's not said. Let's wrap with a simple truth. As a value investor, you're not buying a story. You're buying reality. And reality hides in the details. The flashy slides, the glossy investor deck, the adjusted EBITDA fairy tales, those are the decorations. Your job is to look behind the curtain. Because the long game rewards those who are patient and skeptical. So next time you look at a stock, don't just ask, is it cheap? Ask, is it real? Thanks for listening to The Long Game. I'm Nathan Carter. This voice is AI, but the commitment to truth, that's all human. Invest wisely, ask questions, and as always, play the long game.